Welcome to Make Your Move, the podcast designed to help you get on the property ladder and then figure out what the hell you're doing once you're on there. From deposits to mortgages, surveys to moving day, we can help. Make Your Move is brought to you by Really Moving, the price comparison site for moving home services. Let's get into our episode.
On this week's episode of Make Your Move, we're going to be talking to Brian Murphy, who is the head of lending at the Mortgage Advice Bureau. He's going to answer all our burning mortgage questions, and he's going to talk to us about what opportunities there are for first-time buyers, how mortgage brokers work, as well as what not to do when trying to get a mortgage. Enjoy the show, everybody.
So, welcome to the Make Your Move podcast. This week, we are very excited to welcome Brian Murphy from Mortgage Advice Bureau. Hi, Brian.
Hi, Andy. Hi, Jez. Good afternoon. So perhaps if I can just take a couple of minutes just to explain who I am and who we are. So I'm Brian Murphy. I'm head of lending for the Mortgage Advice Bureau. We're a national brokerage. Some would see us as a network. We have around 2,100 brokers right across the UK. So I wouldn't necessarily quite say we're in every postcode, but we have brokers literally across England, Wales, Scotland and Northern Ireland. We're, like a lot of people these days, a lot of our brokers work from home, but a lot also work within estate agency offices, and many also work very closely with national builders, sometimes parking themselves on new homes build sites as well. We're very prominent, and you can do business with us, be that face-to-face or virtually as we are doing this afternoon, or through telephony or email or any other media. So we're very much open to letting the client lead in terms of how they want to engage with our business.
Perfect. Thank you. Could we start with sort of how do mortgage brokers work in the sort of simplest way? A lot of our listeners are first-time buyers or sort of attempting to become first-time buyers. And I think sometimes it can seem a bit like a huge, scary thing to start the process.
Yeah, no, absolutely. A broker is somebody who acts as the interface effectively between you, the customer, and the mortgage lender. And obviously a lot of people will be familiar and know brands perhaps on the high street. So your Nationwides, your Halifaxes, HSBC, Santanders, and many building societies, including Nationwide, Skipton, Coventry, etc. And they're people that obviously, a customer can go and interface with themselves, either in branch or through telephony traditionally. But what the broker does, effectively, they sort of take away all the sort of hassle of you having to go and speak to multiple, or basically having a multiple round of conversations. Because basically, if you went and talked to the Coventry, you would only get information about the Coventry. Not surprisingly, if you went to HSBC, you'd only get information about HSBC. So unless you've got an awful lot of time on your hands, that's quite a daunting task. And probably the other key thing to say from a broker perspective is that we can deal with all of those, plus a whole raft of other brands who are mortgage lenders, many of whom customers won't have necessarily heard or have experienced, because many of them are only available to the broker community. So now some of those, for instance, will be perhaps engaged in a particular sector of the market. So they may be focused around areas such as, say, buy-to-let, so people who are investing in property to let to tenants. But there will be lots and lots of other brands out there, and I'm thinking perhaps people like Kensington Mortgages, Aldermore, some of other brands which we associate or loosely call non-bank lenders, who are really there only for the broker channel. And what we do is we look across the market based on each and every customer's individual circumstances, and we work out what we think is the best solution to meet that individual customer's needs and circumstances moving forward. So that's very broadly how we work. So we're working on behalf of the customer. We are definitely not working on behalf of the lender. And also what the broker can and will do is the broker can act as that interface, particularly with first-time buyers, perhaps if people are not familiar with the process, in things like even as arranging viewings or putting forward an offer and so forth, or making further inquiries around the property. Because, of course, the broker is interested in helping the client achieve their aim, which is, in most instances, home ownership.
So at what point in the home buying process should you look to hire a broker?
Great question. No one size fits all. I think, again, if we sort of take the first-time buyer market or potential first-time buyer market, so people who are thinking about buying a home or becoming homeowners, they may well have their own perspective in terms of when they want that to happen, ideally. Yeah, they might want that to happen tomorrow. They might want that to happen 3 months, 6 months, 12, 18 months' time. So I think there's never a right or a wrong time, in short. And I think there's nothing wrong with anybody either arranging a call or having an appointment or going and seeing a broker and just having that initial conversation to actually understand what their timeline is. And their timeline, they may have their own perception, and that may change following that conversation, because it may be, for instance, that they don't have enough deposit, or they don't have access to maybe the bank of mum and dad, or perhaps their income is insufficient at this point in order to get them the level of borrowing that they need to get into that sort of entry level of housing, etc., etc. Or again, which I'm sure we're going to probably cover, that their credit report at that time is not of sufficient quality where they can borrow what they need to borrow at that time. So again, and sometimes, if we're honest, with some people, home ownership, it may be an aspiration. I'm not saying it's not achievable, but it may not be achievable in the sort of short to medium term. It may have to be a longer term aspiration for certain people, depending on their individual needs and circumstances or job or income, etc. And actually having that, let's say, relatively frank conversation with the broker will at least position that in a way that people know where they stand. And they perhaps don't then have a sort of false dawn, so to speak. So no right or wrong answer, but again, it depends on obviously what the client wants to achieve as well. And then that time frame may change, but particularly once they've had that conversation and the broker really has a much better feeling of the client's personal circumstances and position.
Yeah, so in some ways, it's a good starting point to get sort of educated in what you need to do next and what's the sort of the right next step for you. Yeah, I think a lot of people potentially, I wonder if it's the other way. I think a lot of people I've spoken to think, oh, there's no point speaking to a broker yet. I don't have a 10% deposit, or I probably don't make enough money, and actually maybe there are circumstances where there's a bit more flexibility.
Absolutely, and that's a great point. So perhaps take that as a lead. A customer, a client, potential first-time buyer may be living at home with mum and dad, or maybe renting or whatever, but they may not have a 10% deposit, and many people do not. But that doesn't mean that they can't buy. So there are plenty of mortgages available for people with, say, more limited funds, 5% deposits only. So that way you actually buy the property with up to 95% mortgage. And actually recently we've seen a little bit of innovation or changing policy, particularly from the Skipton Building Society, where they've introduced a scheme for people who have been renting and where they can demonstrate a period of sustained rent and also maintaining other utility bills and so forth. They, subject to income and affordability and various other sort of stress tests and criteria, they will potentially lend that client up to 100% of the purchase price. So in short, no deposit required. And that is something that we and other broker groups in the market have been pushing for a while, because so many people who are paying rent are stuck paying rent, and while they're paying rent, they're unable to save that deposit. And it's that sort of chicken and egg situation. You just can't do, you can't keep going at the same pace. And we know rents are rising also at a rapidly rising rate. And what this will hopefully do for a cohort of people in the market is to allow them to make that first step. Now, as I said, it's tightly underwritten, and rightly so, and the credit checks, and there are certain criteria over and above other mainstream mortgages. But for a group of people, this is a step forward, and it will be interesting, I think, over the next weeks and months to see if other lenders fall in and maybe look to offer something similar. Which again, more choice brings greater opportunity, and like everything in life, more choice and more providers probably helps bring the price down over time as well.
So is it almost worth, can you talk to a broker before you're ready to actually work with them and say, hey, I'm not sure, and get that advice from them before you actually go ahead and actually use them to find a mortgage?
Totally, absolutely, and that would, we would always advocate, having a conversation in order to understand what it is the client wants to achieve, and the broker will be very frank with them around whether that is achievable or not, or it may be that it's not achievable today, but it might be achievable in 3 or 6 or 12 months' time. And so, that conversation will determine what your level of borrowing might be based on your income or the type of employment and circumstances you have. If you're employed, how long have you been employed? What type of work are you in? Are you perhaps in an income which is likely to maintain relatively stable? Are you in an income which is likely to perhaps rapidly appreciate? So, for instance, if you're perhaps a graduate recruit in particular occupations, legal or accountancy maybe, or medicine or something, you might be on a relatively rapidly rising income expectation, and therefore there might be other products out there which are better suited to you and might allow you to, let's say, even enter into home ownership slightly earlier than perhaps you perceived, because of the fact that lenders will take that sort of thing into account. There are other providers out there who will, for instance, allow slightly more flexible borrowing requirements for people who are in what we loosely call the sort of blue light services. So ambulance, fire service, police, that type of scenario as well. A little bit more flexibility. And also from a lender's perspective, those people are in, I think it's fair to say, relatively secure employment. If anybody's in secure employment, public servants probably more are than others. So lenders are prepared to take a bit more lenient approach in terms of what they're prepared to offer. So they might, somebody who's perhaps a typical first-time buyer or buyers, because most purchases take place with, say, two people. Typical purchase might be able to borrow maybe up to sort of 4.5 times their combined incomes. But for certain occupations or for certain types of employment categories, some lenders will go beyond that, particularly if the combined income reaches a certain threshold. And for others, they might go, for instance, up to 5 times. And in certain circumstances, they might even go up to 5.5 times, which again allows people to get into housing at the step of the ladder earlier rather than later, or it might even allow them to buy into another area where perhaps they thought was out of their reach initially. So lots and lots of options. And until you've had that conversation with the broker, you probably don't know the breadth of the market, if that makes sense. So yeah, absolutely engage with the broker, have a conversation. We can also provide, various tools, apps and so forth, which help people plan in terms of their savings and so forth. So if I was to save X pounds per month, when does that make me sort of quote mortgage ready? Again, have people utilised or investigated things like lifetime ISAs, because effectively, if people use that type of facility as a savings tool, that's free money. Who doesn't love free money? Especially the government are giving you something back. So again, a lot of people won't necessarily have been exposed to that type of thing until they've spoken to a professional who can actually provide some guidance and advice around that.
Yeah, you spoke a little bit there about credit scores. Can you talk a little bit about how credit scores work and why they're so important?
Absolutely. Not every lender uses a credit score, but most do. and some will use it as in the background, although it won't necessarily be a definitive yes or no as to whether they're going to lend to you, but sometimes they use it as a reference tool as well. So yes, in answer to your question, Jez, very important part of the marketplace, because what a credit score really does is it gives a lender who won't know the customer and won't even be introduced to the customer, because obviously the broker's acting as the interface, but it gives the lender a window on their financial conduct, effectively. So it obviously tells them who they have their, say, bank accounts with, what credit commitments they have, be it credit cards or personal loans or maybe store cards or something like that, or car loans often, a lot of people have PCP type agreements and so forth. And it gives them a report on how well the customers conducted themselves with those finance providers. So have they always paid their monthly payment? Have they, in a case of a store or a credit card, have they always paid off their statement, or do they roll their statement on and just perhaps pay the minimum amount? So these things can work for or against you. So if you always, for instance, pay off your statement every month, that's a big tick in the box. You'll get more points, and therefore your scorecard is better. For instance, if you've been late payments to your credit card, store card, that's the sort of thing that can be late. Again, and that would apply equally to other loans and commitments as well. If you've had perhaps got an overdraft facility, but perhaps you've gone beyond your overdraft allowance, that could be a negative, or an unauthorised overdraft. You've gone into overdraft without approval of the bank in doing so. All these things can be plus or minus against you. And from a customer perspective, again, it's important to understand where your scorecard sort of sits before you enter into a credit agreement, such as a mortgage. Because if it's not as good as perhaps you might think to yourself, well, I've never had any debts. But there may be that you've had late payments and you've not realised that has perhaps proved to be a negative factor in determining your scorecard. It may be that you've got something recorded against you which you're perhaps oblivious to. So perhaps if you've been renting, or perhaps you've been a tenant with perhaps in your student days or something of that sort of nature, or been sharing a house with other people, and you've perhaps moved around a lot, things may have been lodged against you and you're not aware of that. And sometimes, unfortunately, credit reference agencies are in receipt of sort of default notices, and sometimes they're wrong. So sometimes people get, information that's recorded against them, which actually isn't true. And then by using, say, something like Check My File, which is a sort of an all-encompassing, allows somebody to sort of see their profile and uses all three primary, what I would call credit reference agencies, which are TransUnion, Experian and Call Credit. They're the sort of operations that all their information is sort of collectively parked on this site. And therefore you can see what your score is. And if there's something that looks like an anomaly, you can then go away and check that out and obviously pick that up with the provider concerned. Because, errors do occur, believe me. And that can be the difference between you obtaining mortgage credit and not obtaining mortgage credit, or it might be that you can get mortgage credit, but you can't get it at the best rates. You have to use a lender who charges a higher interest rate. And don't be wrong, there are people who provide mortgage credit for people with more, let's say, adverse or impaired levels of credit background, but invariably you'll have to pay more in interest terms to generate that. And you probably won't be able to borrow as much either. So that might also limit or inhibit where you can buy and or what type of property you can buy. So these sort of things are massively important to understand. And the third thing to add to that as well is that you also need to make sure that you're open and honest with the broker when having that conversation. So people, can often have, dare I say, selective memory, which is fair enough. But people need to be actually really open and truthful, because if we submit an application on a client's behalf and they've not told us about something in the background, it will be found, and then you'll get a declined case probably from that lender, and then you go to another lender, and that lender will then be aware that there's been a declined case. It becomes a worst case scenario. And again, if you've had multiple applications for credit fairly recently, you might have applied for a couple of different credit cards because perhaps you've got some debt. That's probably not good either.
Would you say, a lot of people, especially with the cost of living, a lot of people do use credit cards, they use loans, they have cars on lease, things like that. Is having debt itself a problem, or it's just how you pay it off? Sure. Or the percentage of debt that you have? Or
Correct. Great question. No, having debt and credit is not a problem. In fact, having debt and credit is good because it allows a potential lender to understand how well or not you deal with your credit commitments. So if you pay everything off on the due date, it's never late, you pay off your statements every month, you don't have an unauthorised, or you don't go beyond your overdraft limit, or you don't go into unauthorised overdraft, etc., etc., that allows them to determine that you are a good credit risk because, everything you've borrowed, you've paid back within the terms and conditions provided. Having no credit equally, no credit at all, is not great either because that doesn't allow the lender to actually get a perspective in terms of what sort of credit risk you represent to them moving forward. So having credit, but obviously having it absolutely buttoned down and paid on the nose month in, month out, and being able to demonstrate that because the credit reports will actually take data back as far as 6 years. So it's not just about what's happened in the last, say, 3-6 months. It's about having that sort of long standing. Again, don't panic on this. Don't think, oh, well, because I had some defaults or maybe a couple of even CCJs or something of that sort of nature 3 years ago. Some lenders will ignore that type of thing, provided it's been within a certain time frame. Often we find buyers, all buyers, not just first-time buyers, but home movers, landlords, etc. People have sometimes defaults for things like telephone accounts, those types of sort of things, where people have perhaps switched providers, and sometimes with a customer there might be a ceiling fee. When somebody leaves a scheme, a contract, and maybe the mobile provider charges them £30 or £50 to sort of cease the deal, but you've cancelled your direct debit before that goes through. If that doesn't ultimately get paid, that company will probably come after you for that debt. And if they don't recover that debt, they might issue a CCJ or something against you, or it's registered as a default. Now, that can be quite serious if you didn't know it was there, which is another reason why it's good to check your file to see if there's anything lodged against you. Credit itself is not a problem, and obviously taking a mortgage is credit. There's no bones about it. It's a big credit commitment for a long time, and therefore, because it's a big credit, and probably for most people the single biggest credit commitment that most of us ever take on, lenders need to be as sure as they possibly can be that you're going to pay the mortgage month in, month out, and that you're going to do it on time, and they're not going to have to be chasing you for, has there been a problem? And there will be problems for certain people because, unfortunately, events happen in life. Unfortunately, people lose their jobs. People, unfortunately, sometimes become ill. They're unable to work generally. They may not necessarily get paid full sick pay, or they might get sick pay for a while, but then it perhaps ceases after, a month or 3 months or possibly 6 months or whatever. If you're self-employed and you don't have what we call permanent health insurance in the background, then you're probably not getting paid at all. In fact, if you're not working, you're not earning. And therefore, what lenders are very, very keen to do is to ensure that they're putting themselves in the best possible position to protect their position, but also putting you in the best possible position so that you don't end up with a debt which is unserviceable and unmanageable. So again, when a lender assesses a loan mortgage application such as we provide, they're not only looking at it just in terms of affordability today, but they're also looking at it in terms of affordability for a rising interest rate market. So if interest rates went from X to Y, could you still afford this loan? And that's been really quite key. That's been a sort of fundamental change which came into the market in 2014, which was what was literally called the MMR. And what that required lenders to do was to stress test a customer against a given set of circumstances.
Yeah, I was smiling when you said that originally about the phone fee, because that literally happened to us when we were buying a flat, and my husband had a 62 pence fine on a old phone account that we didn't know until we spoke to a mortgage
Really
broker.
common. Really
and even
common.
Trying to then pay it because the account had closed, so you can't get through to figure out who.
Yeah, this is really common. Yes.
Yeah.
Correct. How do you pay 62 pence? Yeah. And then how do you demonstrate that the 62 pence has been paid? And the thing is, these credit reports don't get updated tomorrow. They get updated on a sort of cyclical basis. So if you've got your mortgage application in, the lender's obviously done their search and they've seen that you've got that default. Well, it's going to be a while before that default is not showing on your file. You might be able to get some sort of confirmation from the company from whom the default was issued that you have now paid this. Normally that will go to be suitable evidence, but actually on your file, it won't necessarily show for a period of time. Because obviously these things take a while to manifest themselves.
Yeah, we kind of took it that it would take a few months, and it worked out fine. The flat we were going to buy was terrible anyway, so it was actually a blessing. But we we took it as an opportunity to look into our credit ratings and actually improve them, and sort of all the things, being on the register, things you sort of don't check.
Electoral register. Absolutely. Sorry, that's another factor as well. Good point. Again, a lot of people don't realise, that's a big thing. And again, sometimes people, if they've been renting, they might perhaps rent for 6 months somewhere or 12 months and they move around. Perhaps they've failed to register with the electoral register. And that's something, again, that lenders use to basically verify who you are as well, and where you live and who you are as who you say you are and so forth. So things like that, all quite important in addition to credit rating. And obviously, any lender will require evidence as to, who you are. They'll want to see something like, obviously, a passport, driving licence, something of that sort of nature, which, we can do on your behalf as brokers. But in addition, they'll probably want to see something like a utility bill or two, maybe bank statements, all of which, show your name and address and so forth. So yeah, they're the sort of what is loosely called the basic housekeeping points. But again, these are all the sort of things that, first-time buyers in particular, they can do ahead of teeing themselves up for becoming mortgage ready. So if you get all your ducks in a row, so to speak, hopefully putting yourself in the best possible position to move forward at the point when you're either able to do so or you find the property you want to buy.
I was just thinking, you mentioned about being self-employed. So I imagine that has a bit of a different approach when it comes to getting a mortgage. Or I've heard you're not meant to, you have to be self-employed for, is it 3 years or a certain amount of time?
Yes. So yes to all of those in short, but probably not 3 years necessarily. But again, different lenders will take slightly different approaches to how they treat the self-employed. Some are, let's say, more mindful than others in terms of that. So some of the, again, what we would loosely call the non-bank lenders, non-high street brands. Again, I mentioned, people like Kensington, TML, Clydesdale, some of these sort of brands, they very much sort of focus on those types of clients. Some lenders will consider a self-employed client with, maybe only a year's accounts, particularly if they've been working in an occupation, perhaps in an employed regime, and then they become self-employed and they're doing the same type of work. So they've perhaps gone from perhaps being maybe in IT, for instance. Somebody might have been working for a company as an employee, BOA, but then they've set up their own business. They've effectively probably continued to do the same type of work. In fact, they might have even been working for the same people that they used to be employed by, but they're doing it on a contract basis. And therefore they've got a contract, which perhaps is rolling or revolving. And again, a lot of lenders will look at those types of clients with maybe only up to, say, 12 months sort of income evidence. And they won't necessarily always need to be audited accounts. Some will do it on a projection and so forth. But yes, the approach around the self-employed is, should we say, a little more intrusive than it would be for the employed. Because obviously what the lender needs to satisfy themselves is that if it's a business and it's a trading business, that it's doing the level of turnover, or how's the client being paid? Are they being paid through dividends or obtain profit, or, et cetera, et cetera. So different lenders look at the methodology in terms of how their company set up in slightly different ways. But again, some of them are specifically set up to deal with that type of business. So it's not a no-no, but probably slightly less options than perhaps somebody who's in, let's say, mainstream employment, but wouldn't necessarily pay a differential for that as a result. But again, because we've had things like the pandemic in the last few years, and therefore a lot of people would have had quite perhaps significant gaps in earnings. Some people were furloughed. Some people, obviously, the business almost sort of ceased trading, or they couldn't work because of have to be home-based. Again, that's caused gaps in the ability for some people to generate accounts over 2, 3 years. They might have had 2021 or 2020, and then a gap in 21, and then back in 22, and then 23. You haven't got that linear line, perhaps, of history. But again, lenders are being much more pragmatic around that sort of thing now and saying, well, the reason we've got a dip in income in 2020 or 2021 was we had the pandemic. And clearly that person perhaps couldn't perform that role at that time because obviously we were all in lockdown. So factors are, there is a much more what I would call realistic approach being taken to some of this stuff than perhaps historically would have been the case, because that's the world we now live in. And that's become the new normal, shall we say. And obviously something like, I think 5 million people in the UK are deemed to be self-employed. And that's a pretty significant part of the workforce. I think there's circa 30 million people in work, of which around 5 million are self-employed in varying degrees. So that's a pretty big part of the workforce, and they need the same access to finance as the rest of us.
So when someone thinks they're ready, or they want to think about applying for a mortgage, what would you say is the first thing someone should do when preparing for that process?
Are we assuming that they've already had a conversation with the broker prior to give them that sort of understanding of, probably what they can borrow and Yeah, okay. So obviously, we would normally arrange a mutually convenient appointment. We'd obviously complete the necessary documentation and paperwork, so take all the evidence that we need to provide to the lender. And that would again include, for instance, in the employment service sector, we'd need to see evidence of one's pay slips, although we hopefully would have seen those at least provisionally in the previous interview, whenever that took place. We'd probably want to see, 3-6 months levels of pay slips. Probably bank statements as well in support of that. Obviously, make sure that the two tally up, that everything's right and above board. P60s, things like that are very good as well. And then obviously for the self-employed, we'd obviously ordinarily need to see accounts and HMRC sort of documentation confirming, tax paid and things like that as well. All of which will sort of hopefully confirm the levels of income that the client's disclosing. The customer would normally go through a process whereby we'd submit the application. They'd normally pay any fees associated with the mortgage products. Sometimes there might be a booking fee or an arrangement fee, which is charged by the lender. There may be a valuation fee, although in the purchase arena these days, a lot of lenders now provide what we call a free valuation. So the client doesn't actually pay that per se. Depending on what proportion of the purchase price the loan represents, i.e. the loan to value, some lenders now undertake what they call a desktop valuation or an automated valuation, but they don't actually necessarily physically visit the property because they've got data from data sets effectively where they can make an informed decision as to the property's value or worth. But normally if the client's borrowing, let's say at 90 or 95%, they will probably want a surveyor chartered surveyor acting on behalf of the lender to go and visit the property and carry out a basic mortgage valuation. Now, that is not a survey. That is just purely for the lender's purpose, to get a perspective on whether or not that property offers mortgage security. So does it represent value? So let's say very crudely that the property is priced at £200,000. The client is borrowing £180,000. Does that property provide security for that £180,000 of debt that we're issuing? And obviously the surveyor will sort of come back and say, in most instances, yes, it will. Sometimes there won't. Sometimes there might be a down valuation, depending on perhaps the repair of the property. On the other hand, ordinarily, once that corroboration has been achieved, the lender has done the necessary checks and balances that they need to do. Invariably, they tend not to necessarily write to employers in the way that they probably did years ago. Sometimes they'd write to employers to confirm income, but normally when you come evidence in the form of online generated or printouts of payslips, P60s, accounts, that type of thing, all of that is sort of evidential. And also lenders have abilities through API linkages to actually corroborate a lot of that information through third-party sources as well. So, if you said somebody owns £40,000, often the lender has got systems and checks in the background that is doing some further data checks to ensure that that's the case. All of this sort of takes place in the background. Obviously, they're looking at the credit file reports as well, assuming, and again, based on the score, will determine whether or not you're sort of good to go or perhaps not. Sometimes there's queries, sometimes if there's anomalies in pay, for instance, if people have a degree of income which is variably based, performance-based, might be sales-related or something. So somebody might have 60, 70% of their income is, say, basic, and then another 30, 40% might be based on performance to varying degrees, or sales performance data, or even things like overtime or commissions or something like that. Some lenders won't necessarily take all of that income as being evidence of income. Sometimes they'll only take a proportion of that, because, of course, it's not necessarily guaranteed. So they might, for instance, if you had, say, 30% of your income, which was variable pay, some lenders might only take 50% of that for calculating what they'll lend you. Others might take 75, others might take 100. But again, of course, a customer, though, or a buyer, wouldn't necessarily know that. That's why you use the broker. The broker has that knowledge and understanding. You could walk to 2 or 3 different lenders and come out with 2 or 3 different answers, and you wouldn't know why you got those 2 or 3 different answers. That's where the broker comes into play. And basically, while that's going on in the background, the offer is then generated, assuming everything comes back with a tick in the box. And actually, what we're finding the last sort of couple of years is that lenders' performance in turning around cases from sort of application to mortgage offer has actually improved quite significantly. So if we go back probably 3 or 4 years, it wasn't uncommon for lenders to be sort of probably issuing offers somewhere between sort of 15 and 20 days. Sometimes it can much, much faster than that, but sometimes, that was probably the average. Not just since COVID, but actually since the last couple of years, quite a number of lenders have upgraded their, what we call, platforms that they assimilate all the information on, and that's allowed them to work a lot more efficiently. And again, even allowing for remote working and things like that. And therefore, a lot of what I would call the manual processes have been taken over by technology. And then what they're using the people for is the actual underwriting the deal, and actually scrutinising the information and what we call underwriting, actually making a decision on the case. So what we found probably in the last year or two is that probably on average, application to offer has probably come down to maybe to sort of 10 days, 12 days. And many are performing under that as well. So it's a pretty straightforward process. We've got, as you're probably aware from the press at the moment, there's a lot of volatility in the market at the moment in terms of pricing. Lenders are having to, in many instances, withdraw product ranges relatively short notice because of pricing changes that they're incurring. And also, if one lender pulls a range of products currently because they're getting a lot of volume come through, that then pushes volume to other lenders, i.e. in terms of where people sit in the cost index, if you like. So mortgage brokers use sourcing systems to actually assimilate and determine who's pricing and sourcing best at this point at any moment in time. But if you take, say, the top 6 lenders, who probably collectively account for 70%, 65, 70% of the market typically, if you take one of those out for a couple of days, that 10 or 12% of the business that they would ordinarily be doing suddenly has to go somewhere else. But if it goes to one of the smaller providers, because that smaller provider is particularly well priced at that point in time, that can mean a massive wall of business coming into that lender within a matter of hours. And they might typically get a couple of hundred cases a day ordinarily, and suddenly they might get 1,000 cases in over a day. And then the effect on their ability to service and get those offers out is obviously not surprisingly massively impacted. So, the volatility in the market is a problem at the moment. That's not something the customer needs to worry about per se, but what it does sometimes mean is that where we think we've got a product today with a particular price that we're going to apply it to you for, unless we can get that case in and packaged by a certain point in time, maybe it could be, say, 5 p.m. this evening, that deal could be pulled. And then when the lender come back in, could be the next day, could be a couple of days later. Invariably at the moment, prices have gone up. So that, again, causes additional trauma, stress, hardship, and for everybody, 1, for the broker, because it's more work, but 2, for the client, because probably the price has gone up, which means that their mortgage repayments will have gone up as well. So, this is sort of contra to where we've been for the last few years, because really since 2012-13, mortgage pricing has been sort of steadily falling until last year when, the war in Ukraine and obviously what that did to inflation as we all know it, and then what that's done to Liz Truss's government intervention in September last year, the mini budget, when we know what that did to the bond markets and so forth, and then the impact that had on the swap markets. And so, the Bank of England were raising interest rates anyway, albeit more modestly. But what we've seen in the last, say, few months is we've now got a base rate at 4.5% as we sit here today. The Bank of England committee are meeting next week to take a view on the next possible change in rates, and the likelihood is we'll see a further rate rise. But the last couple of weeks, as I said, the swap rate market has been quite volatile, and rates have been literally sort of like their swap rates. And so as a consequence, lenders have invariably been putting their prices up, one, because they risk being underwater with their price that they're currently offering their mortgage products at, and therefore losing money, and two, because the volume of business they're sometimes getting is more than they can handle, so they price up in order to discourage business for a period of time. But if one pulls out for a couple of days, as I said, that then heaps more pressure on others out there. And if you're a small player and you've suddenly become extremely attractive from a price perspective, sort of be very wary, because the chances are you'll get hit with a mountain of business, because there's probably in the region of, certainly more than 15,000 brokers in the market, could be 25,000. I don't quite know the actual numbers, but, suddenly many of those suddenly focus on one particular lender. The lender's got absolutely no knowledge of how much is going to come in and when it's going to come in. It could be that there's 10 deals an hour coming in, and then suddenly 100 deals come in an hour, and then another 100 deals. And before they can actually withdraw those products, they might have taken 1,000 deals in, because withdrawing products is all very well, but there is a process they have to go through to do that. So it's a difficult market at the moment for brokers as well. But that's what we're here for. But it's even more difficult if clients are trying to manage that themselves, because they won't have that knowledge and information to know what's coming down the line. And that's where brokers are there to help. As I said, they're acting on behalf of the client. We are the customer's agent.
Yeah, I think the idea of trying to do it yourself must be horrific.
Well, if I can give you some further context, in 2022, Mortgage Advice Bureau, just us as a brokerage, we dealt with 108 lender brands across the UK. That's the range of providers that we utilise to find mortgages for all the clients that we generated mortgages for last year, which, by the way, was over 150,000 transactions last year. So, and the market's changing always, because every year perhaps another couple of lenders come in, maybe perhaps a lender disappears, but, new lenders come in, sometimes got slightly different propositions, which means that they might be slightly more open to particular sort of client sector and so forth. And again, that's fine, because it brings further choice generally. So the market has grown, and there's more lenders now than there were 3, 4, 5 years ago, and we think that will continue to be the case for the foreseeable future. But, like everything, there will probably be 1 or 2 lenders that over time perhaps don't survive, or perhaps choose to exit the market because they're perhaps not making enough money, or perhaps they've just determined that sector of the market is too competitive to be effective in and create the sort of margin that their investors want. But, again, that's where brokers are there to guide the client. I could probably name half a dozen lenders that, to be frank, you probably would have never heard of, and you would never have found, had you been left to your own devices. But actually, you wouldn't have been able to transact with them even if you could, because they will only accept business from regulated entities such as ourselves. Something in the region of 81-82% of all mortgages originated in 2022 were through the broker channel. And also, if you go to the high street, you don't know, unless you've done a real lot of research, you don't really know at that point when you walk into any of the high street brands whether that brand sits at the top of the tree or the middle of the tree or the bottom of the tree in terms of their price. When you can go on to plenty of comparison websites. But again, these things changing constantly. And sometimes going in to see a high street brand, you won't necessarily get to see a mortgage advisor there and then. You might have to book an appointment, and invariably, sometimes that booking an appointment might just take a couple of hours, might take days, but it can often take weeks, because, again, a lot of lenders have really cut down on the amount of customer-facing advisors they actually employ these days. They would rather the business came in generally through the broker channel, because they're not employing those people. Now, you might see a deal on the high street which could be the top deal in the country, but your ability to access it may be impacted by the fact that there is not the capacity within the lender to see you as a client. So you miss out. But actually, if you'd come through the broker channel, you would have got it. Because most brokers will work not just 9 till 5, they'll work, into the evening, on weekends, and they'll get your business submitted in order to get you over the line.
Yeah, so kind of building off of being ready to apply for a mortgage, is there anything or things that you as a customer really shouldn't do when you're ready to apply for a mortgage?
I would probably say, Jez, don't apply for multiple credit in the lead up to coming for a mortgage. because that would probably get, a lender will see that. Even if you don't transact, they will see that there's been an application for credit, and they would probably question as to why. So, for instance, somebody might have used, using the raising of a personal loan, within a sort of window in the lead up to perhaps applying, they might be using that to fund their deposit. Now, because most lenders will want to see the source of deposit. So if you've got, your 5% or 10%, whatever it is, have you been saving? Where has that deposit come from? Is it something you've saved over, 1 year, 2 years, 5 years? Has it been gifted to you? That's not a problem, but they want to see where it's come from. Is it your own money? Was it gifted? Was it family money? That's fine as well. But if it's been derived from another provider in order to find 5 or 10 or 15, whatever £1,000, that's another credit commitment that you've got, which will probably nullify what that lender is prepared to lend to you, because they know you've got a credit commitment now to generate, to repay £10,000, probably on a personal loan basis, which is probably more expensive than it would be on a mortgage basis, and over a shorter period of time as well. So they would probably be the things I would generally suggest that people didn't do. If they need to raise money for a particular purpose, that's different. But if they're using it for that reason, then that's probably not a good idea. But again, we all sometimes need to go and replace the car, or one contractor's ended, another one needs to start. That's different, because all of that will be factored into your overall affordability. But using those funds to fund your deposit is not good, because again, that also shows that you've not had the ability probably to save what is deemed to be a reasonable level, 5%, through your own sources, so to speak.
Do people really try to do that? They try to pay for their deposit.
Well, some do, and some will do. But a lot of lenders will see that as a negative and a no-no. But it can sort of come through, and there might be reasons for it. Again, it might be that somebody's been financially, dare I say, caught short, whereby they've had money and they've had to pay that money out for something else, and then But again, you'd probably need to evidence and demonstrate that in some way. So, perhaps by way of example, maybe somebody might have had a debt or a tax bill or something like that they needed to pay, and they needed to pay that off. And obviously, you can't say no to the HMRC. So you pay. So that was my house deposit monies. But if you can show that money had been sort of saved up over a relatively, sustained period of time, then there may be reasons, and somebody may allow you to do that. However, again, the fact that you've now got a new credit commitment to cover, say, £10,000 or £20,000 or whatever it is probably going to be a more expensive way of borrowing than if you had borrowed it on a mortgage, or more of it on a mortgage. So, but again, just taking on credit in general in the lead up to a mortgage, probably not a good idea, because new credit commitments, if you don't really need them, are probably going to work against you, particularly if you're leaving balances outstanding and things like that as well. And also, if people get rejected, don't then apply for another one. And then, because again, those footprints, will potentially impact negatively on you in terms of, future credit. Again, there are lenders out there that are more than happy to take that on board, but it probably means a high level of borrowing cost in order to get you the funds you need.
Would there be, I suppose, the other side of that, sort of things not to do, or whether it has an impact, if your income is going to be impacted? So I assume like changing job before you get a mortgage, or if you were going to go on to maternity leave and things like that, does that make a difference?
Well, yes, it can do. But again, if you if somebody comes in with the express intention of taking a mortgage and then going on maternity leave, and you're not, you weren't aware of that, then is the lender going to know? I suppose the reality is, so if somebody's sort of planning, I'm going to get my mortgage and then I'm going to get pregnant and go off maternity leave, that probably happens all the time. If somebody comes in with the express intent of, going on maternity, if they're presumably joint mortgage borrowers, something like that, the income is going to be assessed on their income, but obviously they're going to be on maternity, their income's going to drop for a period of time, and then they may or may not be coming back to work at some future point. Again, the lender's going to be a little bit more cautious around that, but are they going to know they're on maternity at that time, or sort of they're planning on maternity? The broker would have to notify them. But obviously, if it's patently obvious, then I think it's on the broker's responsibility to do so. Sorry, what was the other part of the question?
Changing jobs.
Sorry. So again, obviously, people change jobs all the time. In general, most lenders are not too concerned with a change of job, particularly if you've gone from employer A to employer B in the same industry, and you've probably gone perhaps for more money or better terms, conditions, etc. The lender can see you've changed for the right reasons. You've gone from earning £40,000 to £50,000 or whatever the number is. Some lenders will be a bit more careful around things like initial probationary periods. So you might be in a probationary period with a new employer. whereby, you're not guaranteed until you work there for, say, 3 months or 6 months, possibly, and you get your probation signed off, etc. So some lenders would be a little bit more concerned about that. But again, if you've normally gone from a job A to job B and you've progressed, you've done it the right reasons, the employer's taken you on for that reason, and most lenders are pretty relaxed around that sort of thing. Some might have require you to have been there for a given period before they will allow you for that income to be utilised in the same way. The self-employment one is probably more challenging. So if you've gone from being employed to self-employed and you're doing that next month, that's probably a no-no because you've got no track record as a self-employed person. There might be certain circumstances where you're going as a contractor and you're perhaps even contracting back to the company from whom you were employed before. So, some people do that where they've gone from being employed to self-employed, working for the same organisation, and effectively they're getting paid a daily rate. Now, again, there's a number of lenders out there that will probably consider that, but it might depend on, again, what proportion of the property purchase price you were borrowing. If you were borrowing at 95%, they're probably going to be more circumspect. If you're borrowing at 70 or 75%, they're probably going to be less concerned. By going from employed to self-employed, you're probably gone from a salaried position of X pounds to a daily contractor rate, which probably has jumped your salary twice over. But obviously you've then got the responsibility of doing things like paying your own tax and NI, considering things like pension provision, which obviously the employer has no longer any responsibility towards, etc. And also probably providing for things like, maybe private medical and et cetera, and paying for holidays, because obviously you won't have any holiday pay or sick pay as you would as an employed person. So there's lots of pros and cons as to why somebody does that. What obviously lenders are really good at doing is working out the fact that you might have gone from earning X to Y, that everything now rests with you. And therefore, how much of that income they will consider to be useful for mortgage assessment purposes, will vary, very much between lender to lender to lender. But, some are more comfortable with lending in that space than others. And actually, often it's the non-bank lenders and often people like the smaller regional building societies. They've got a real appetite for that type of sort of business. They really focus on that sort of thing because they have the resources to sit down and understand the client and underwrite the client on what I call a human basis, rather than using a scorecard and a credit score type sort of position and just, mass data and so forth. Yeah, they just don't have the volume going through the Big 6, Big 10 do.
I think thank you so much for speaking to us today. I think what a lot of our listeners might be surprised by is that perhaps it's not all as doom and gloom as it sounds. When we sort of see it on the news or people talk about mortgages, it does always tend to be a sort of fear-based, things are dropping out, it's volatile, we can't do anything, you probably can't afford a mortgage. Actually, it sounds like it's a lot more personal, where it's, your individual circumstances are taken in.
Absolutely. That's a great point. Just probably what I'd say in summary is that I think people should try and not ignore, but they should try and put to one side the interest rate number, okay? Because we all get a little bit hung up on rate. Interest rates typically have gone from sort of circa 1 to 2% 12, 18 months ago to 4, 5, 6% now. Now that's a significant leap. I'm not underplaying that in any way, shape or form. But at the end of the day, it's about what people feel comfortable with paying. And we'll all have in our own minds a budget that we feel comfortable with or not. Okay. And obviously the lender does the same. So the lender will look at the client's income, and they'll also very much look at a client's typical expenditure. And they'll do this on what they call a detailed affordability summary, where often they'll take what we call ONS, Office of National Statistics data, easy for me to say, and they'll look at you as a sort of customer against the norm. And if you've got expenditure which is way under the norm, they'll probably apply the norm. Yeah. But if you're way over, and there may be reasons why you might be way over, they may take your data as well, and that might mean you can borrow a little bit less than you would ordinarily. So lenders are always erring on the side of caution. And of course, as I said, they will also have to build into their affordability potential future rise. And obviously most people over the last few years, the last 15 years generally, tended to err on the side of fixed rate mortgages, be they 2-year, 3-year, 5-year, etc. But we've seen a little bit more appetite, certainly following the mini budget last year, for people moving to tracker rates, although that's probably sort of eased back a little bit now because obviously rates have continued to rise beyond where most people expected them to plateau. However, a lot of people, will say, for me, my mortgage budget is, let's say, arbitrarily £1,000 a month. Because somebody might have been paying typically in a rental, because I think the average rent across the UK is about £1,000, £1,100 a month, depending on where you are, of course, in the country. So people might say my budget's £1,000 a month, provided my mortgage fits within £1,000 a month, give or take, plus all the other utility bills. I don't care what the number says on the front. I'm happy to pay that. Now, obviously, people need to have a degree of flex over and above that as well to what I would call plan for a rainy day, because who knows what's around the corner. But on the other hand, the lenders are doing that as well because they're building in that degree of flexibility and headroom, as they call it, in terms of stressing the client against when they come out of the fixed rate, where rates may be thereafter. And yes, rates have gone up a lot. But for a lot of people, the number is almost a secondary consideration. That's whether we're arranging rates today for people for new mortgages at 95 and some of these new skip-to mortgages, and the rate is on those in the high fives and probably approaching 6%. But provided it fits within the client budget and obviously it meets the lender affordability, that's fine. Because for some people, owning the home and paying at 5 and 6% is better than renting the home and not having any housing equity growth moving forward, and that effectively paying somebody else's mortgage. Because all the while they keep renting, and again, for many people that don't have the benefit of the bank of mum and dad, or just as I said earlier, can't save because they're continually paying rent, they'd rather pay now and get on the housing ladder and hopefully build some housing equity, knowing that in time, that housing equity will mean they'll pay their mortgage off, assuming they make their payments over 10, 20, 30, whatever years. And at the end of it, they will own that house outright. And then they don't have to be paying rent in retirement out of probably a substantially lower income. And that's a key factor in this country. There is a big cohort of people who are probably going to be financially quite poor in their later life because they haven't invested in property, unfortunately, or they haven't been able to invest in property. And they're going to be forced to pay rent, market rent, on a level of income which is nowhere near what they would have had as earnings, while they were employed. And for some people also who haven't got good or adequate pension provision, they're going to be paying that on, let's say, state pension and a bit of whatever they've accumulated through private means, which for many people will probably mean that they're living a very, very poor lifestyle. Whereas at least if you're owning your own house, that's probably your biggest part of expenditure, as we said, be it rent or mortgage. And if you haven't got that rent to pay, that's, £7,000, £8,000, £9,000 a month you're not having to pay out. And that's a really big factor moving forward. So hopefully that gives you some context as to, I think for a lot of people, yes, interest rates are significantly higher than they were, and they'll probably continue to rise for the short period. But hopefully we will get to a point of plateauing again. I can't give you a crystal ball scenario of when that's going to happen. That's, it's way above my pay grade. And if I'm honest, I don't think the Bank of England know that either at this moment in time. But the reality is rates will probably plateau at some future point, probably fall back at some future point. Do they get back to where they were 12 months ago? Probably not. But probably the next new normal will be somewhere above where we were 12, 18 months ago, but not where we are today. And there will be a period of adjustment. And again, as the old boy in the room, when I took my first mortgage out, I paid, I think it was 11.2%. But my mortgage was so much smaller then than it is today in relative terms. So it is all relative. We have had an unusually long period of ultra low interest rates, and that's been largely attributable to various economic issues, not least of which was, of course, the pandemic, which absolutely crucified the economy for a period of time. But, other factors have come into play now, as we said, through, largely as a result of the war in Ukraine, what that did to things like oil prices and grain prices and gas prices. And of course, how that feeds into all the products and services that we all tend to buy and utilise as a consequence of that. And then the budgetary issues that occurred last year, as we know, it's caused a lot of pain and damage. And until inflation gets back under control and people can see it starting to drop in a meaningful way, interest rates are going to remain elevated. But hopefully we're getting towards the top of the curve.
Brilliant. Thank you. That was, I hadn't even thought about the fact, the impact on renting long term. We've talked a lot about, with some of our previous guests, about, whether it is better to jump on the ladder with something that's not perfect, but you can afford, that works for you, just to get there and then, move up as you're on.
Absolutely. I mean, look, Andy, there's no right or wrong answer because, again, it's very much a personal decision. And we're not here to say people should be buying or they shouldn't be buying. That's got to be an individual decision that each applicant or applicants comes to individually or collectively together, because people have got to do what they feel is right for them. We can provide advice on the whys and the wherefores of what one course of action might do versus another, but people have to make their own decisions. But as I say, we're still seeing in our market, and again, and hopefully this is a positive statement, we are still seeing good levels of home buyer and still seeing relatively high levels of first-time buyers coming into the market, because people are genuinely saying, well, I have to live somewhere and I'd rather be paying money. If I'm paying money out, I'd rather be doing it as an owner than as a renter, assuming it's broadly similar. If home owning was twice as expensive as renting, people probably wouldn't be doing it, but it's currently not, even with interest rates having gone from sort of 1-2% to 4-5-6%. And therefore, as a consequence, people are being pragmatic, and I think they're making individual choices which are they feel are right for them. And we've had even less transactional activity in certain times when interest rates have been ultra low as well. Again, it's how people feel about themselves and what's right for them individually. And no two customers are the same. And that sounds like a bit of a cliche, but it's absolutely true. You could have two people with the same jobs, the same incomes, the same almost sort of backgrounds, but they've got two different perspectives in terms of what's important to them. And it's about individuals making their own choices. We're here to help them fulfill that, and hopefully help more people into home ownership.
Oh, I love that. Thank you. That is comforting. Thank you. Thank you so much, Brian. It's been brilliant to have you on the podcast.
Pleasure. Thank you very much for inviting me.
So that felt like a surprisingly positive talk about mortgages.
Yeah, very interesting, actually. I'm very surprised by how individual it is, because I always had this idea that like if you did one thing wrong, they'd be like, no, can't get a mortgage. Like you change your job, you can't get a mortgage. But to hear that it's like they take it more case by case, and it's like if you can just prove like, hey, I can still pay back, you'll be approved. That's really that's a positive thing to take about it. That like it's not like one rule of like this is how you get a mortgage, this is how you don't. You could prove that you're okay to get one on your own individual merit, rather than just sweeping statement about lenders.
Well, it's just a lot more about being a human rather than being a number on a page, which I thought is what it was, which is lovely. Yeah, I can't imagine having to do that without a broker.
Yeah.
Because they have such access to all these different deals.
And it sounds so hands off, like you just let them kind of take care of it. Like you just focus on the things you need to do, and they can do all the complicated bits.
Yeah, I wouldn't want to have to do all that research on understanding rates and things. I would much rather someone who's an expert could look at what I make and what I spend and be like, this is what you can afford. This is a good deal for you. But yeah, I really hope that people who are listening feel emboldened by that to actually go and talk to a mortgage broker.
Did we establish whether you can talk to them for free if you just want to like chat with, because he was saying about you chat with them to decide whether you're ready. And you might not be ready to.
That seems to be free. From
you can just get advice from them, which is, I think, sounds like a very useful thing to do. Just get advice, because then you might be like, oh, I can't afford a mortgage right now, and then come back to them later. But being able to just talk to them about, like, is it doable for me? It just takes a lot of the guesswork out of it.
Yeah, I think because we can give, we can say you can probably borrow 4.5 times your income or whatever, but like Brian said, if you are going to become a doctor or you're on a career path that's going to grow, there might be more options for you. So it's a great place to start with free information that's personalized to you. So we have rough amounts. We can say 4.5 times your income as a general rule, but actually to get a really personal start to your buying journey that kind of equips you with what you need to do next. So if you need to go check your credit score and improve it, if you've got debts you need to pay off, it just seems like such a much more positive, hopeful, personal way to start the process. And so many people, like Brian said, don't have a 10% deposit. And Kate said the same thing last week. Mm-hmm. But you shouldn't let that stop you just because it seems to be the standard number we pick. Actually, there are options, and there's loads of them out there. We just don't always have access to them because they're personal to you. So I think this was a really interesting episode, and I'm so pleased we had a mortgage expert to talk to. The one thing I've taken from this podcast today is that the numbers we hear on the news aren't necessarily the ones we should be focusing on interest rates and things like that. When Brian was right, it's about what you can afford and whether it works for you, and whether buying is worth it for that price, and that things probably will regulate. So we have to sort of have a long-term view.
I think the main takeaway for me is to make sure you're keeping an eye on your credit score, because it's scary. It's scary to always talk about credit score, but it is really important. And the fact that there are things that can happen that you don't even know about, but there are ways to look at it and find those things out before you do anything. So yeah, just to keep an eye on your credit score, even when you think you're fine. Always keep an eye on it and be aware of what's going on, and then you won't be caught out.
Yes, and we've got a good few articles on the site about credit score and what you can do to fix them. I personally am obsessed with the ClearScore app. It is very much about gamification for me. I've also used Experian Identity Services, which is another way of checking your credit score. You get it free for 14 days, I think, and it's really, really in-depth. So it's basically both of them just provide you with a checklist to improving your credit score, but you should definitely check out our articles on the site as well. So thank you very, very much for listening to this episode of Make Your Move. We feel like we've learned a lot more about mortgages and we hope you do too. Next week, we are talking with Mr. Numbers about property data, what's happening in the industry, where are people moving, what kind of properties are they buying, and where can you find a good deal. Tune in next time.
You've been listening to Make Your Move, the podcast here to make moving simple. We hope you found this episode useful, but as always, everyone's situations are different, so make sure to do your own research before making your move. Make Your Move is brought to you by Really Moving, the price comparison site for moving home services. If you have any experiences or questions you'd like to share or ask that might be put on a later episode, please email us at podcast@reallymoving.com. See you on the next episode.